Welcome, guys. It's your boy Jane. Welcome back to my channel where we talk about all things stock and investing. Uh, I'm late to the party. Last week was crazy with the whole Gamestop, AMC, Nokia, BlackBerry, all those plays. Hopefully, you guys made some money from those plays. If you did, please go ahead and comment down below what happened. If you lost money, also comment down below. For me, last week was break even. I only made two plays. I hopped into two options plays. One on DraftKings, which I made money there, and one on AMC. I hopped in at the wrong time and I lost the exact same amount of money that I made on DraftKings. So it was break even for me. I didn't make much, I made $0 last week. Yeah, with the whole thing last week, I know you guys have been hearing a very common term being used, the term short squeeze. And here on my channel, I try to introduce you guys to strategies that you might come across in investing, and I try to also explain popular or common terminologies that you might hear. So I'm going to go ahead and dive into what a short squeeze is. I'll try to explain it as best as I can. Before I go ahead and do that, please subscribe, like, hit the notification bell. Also, if you guys are still interested in, signing up for Robinhood, I know you guys have probably heard what Robinhood did last week as well. But if you still are interested in signing up for Robinhood, please go down to the description. I have links there. If you sign up, we both get a free stock. I also have a link to Acorn. If you sign up there, we both get $5 in investment portfolio. So the choice is yours. Now, what is a short squeeze? For you to understand what a short squeeze is, you have to understand what a short is. Now, a short can be very complicated, but I'll try to keep it as simple as possible for you guys. If you want, I'll do an in-depth video on what a short is. But essentially, what a short is, you're betting that the stock will go down in price. So when we purchase a stock or when we buy a stock, we're betting that the stock will go up in price, and we collect our earnings or our profits through it, going up in price. When you do a short, you're essentially betting that it will go down in price, and that's how you collect your profit. But how does that work? So when you short a stock, you have to borrow the stock from the broker, right? And you sell it for its current value, hoping that it will go down for it, and you repurchase it cheaper. An example of this is, let's say we have stock XYZ, and it's currently trading for $10 a share. Or you think that it will go down. Let's say you heard some news, it's overvalued, or there's some pending bad news coming, and you say, hey, I think the price of this stock is going to go down, so you want to short it. So you go ahead, you place a position, you are essentially linked the stock, right? You sell it for the current value of $10 per share, and you wait for it to go down. So let's say it goes down to $5 a share, right? You repurchase the stock with the $10 that you have initially. You repurchase it, and you keep the $5 for yourself, the $5 profit that you made, right? Because 10 minus 5, $5 profit. And you return the stock that you borrowed to the broker. So that's how it works. You sell it for its immediate value, wait for it to go down in price, and you repurchase it when it's cheaper, and you return it to the owner. There are some complications with when you do this, however. And how does this whole thing cause a short squeeze? So, a couple of things. When you short a position, you have to pay interest on the position while you're holding. You also have to pay out dividends. If dividends are paid, because you borrowed the stock from someone, so you have to pay interest on it. Also, when you buy a stock, right? So just to backtrack a little bit, when you buy a stock, you have unlimited reward, but you have a limited risk. What do I mean by that? With the example of stock XYZ that's trading for $10, if the stock were to go or the company were to go completely out of business, the most you will lose is $10, because it will go from 10 to 0. The lowest a stock can go to is $0, right? You have unlimited reward because the stock can essentially go to an infinite number. But let's say for purpose of this, it goes to $20, you make 20, goes to 30, so on and so forth. When you do a short, it's the inverse. So you have a limited reward, but you have unlimited risk. So, same example, stock XYZ trading for $10. The lowest the stock will go to is zero, meaning the most money you can make is $10, right? It going from 10 to zero, $10 profit for you. But the most it can go up to, again, it can go to 10, 20, 30, 40, 50, 60, $1,000, right? You lose all that money when that happens. So this is where a short squeeze tends or starts to begin. Because what happens is when the stock starts to go up, you have to cover your position, meaning you have to purchase the stock to make the broker whole. Because remember, you borrowed it, right? So you have to give it back and make the broker whole, but you have to purchase the stock at the higher value. You purchasing the stock in itself at a higher value causes the stock to go up. So other people who are shorting the position as well tend to get squeezed out of the position as it goes up. So that's what happened with in the case of GameStop. A broker or a hedge fund had a huge position, a short position, betting that GameStop will go down, and a group of retail investors said, "Hey, we're going to buy this," forcing the price to go up. When the prices go up, these hedge funds and all these people, they have to cover the position, so they have to purchase the stock at the higher rate, causing the stock to go up even more. So that's why GameStop went up astronomically to the moon during that period of time. So that's essentially what happens in a short squeeze. Hopefully, I explained it. I try to keep everything simple, leaving out the finer details and stuff, but that's essentially how a short squeeze work. Just to recap, you purchase it at X position, you're hoping that it goes down, but it actually goes up in value because I shouldn't say purchase, because you borrowed the stock. You have to, make the broker whole again. You have to give it back. So you have to then purchase it at a higher price, causing the stock to go up even more. Also, another thing that I left out is we know that stocks, there are a limited amount, right? So case again, XYZ. Let's say the company only has 100 shares. If all the people are buying the shares and they're not selling them, that also causes the stock to go up in price as well. The whole thing with supply and demand. If there is um, limited supply but huge demand, that causes the value to go up as well. So that causes it to go up, and it squeezes people who are betting against it to go, down to cover their positions, and they essentially cause the stock to go up even more. They lose money, and the people who, obviously bet that it would go up make money. So that's what happens in a short squeeze. I know I'm rambling at this point, but if you did stay to the end of this video, please go ahead and again subscribe if you haven't already, like the video, share, and yeah, that's it until next time. I hope you guys have a good one.